It's a good morning from me, and it's a good morning from him. Actually, it's this afternoon now because it's actually 1 minute past 12 or half a minute past 12, and it's a Tuesday. It's not a Monday because there was a little thing called a football match on yesterday, which kind of takes precedence, really. But anyway, enough of that. Let's say hi to you. I'm Paul Archer, but you know that, of course. And I'm here to help you with your lunchtime live stream, help you with your mortgage business, with maybe your financial services business, because restricting yourself might not be the best thing to do moving forward, because there's a whole lot of people crying out for financial advice now, a whole lot of clients wanting financial advice, not just mortgage advice, but that's for you to think about for the future. Anyway, a couple of topics for you today. I want to give you a bit of O'Leary, which is Ryanair's big boss man. Great guy, actually, quite like him. I'll give you a few words of wisdom from him. And then I want to just give you a little bit of an update from last week's autumn statement that our new Chancellor gave, which most of it was all taxes and fiscal drag. Great, whoever came up with that word, I have no idea what they were on about. Their fiscal drag, it just sounds awful. But there's another thing there which affects mortgage advisors. So I want to talk about SMI and the updates to support for mortgage interest, particularly for equity release, which you might not have thought about actually, but that's just the brain working away on that topic. Anyway, I hope you're well. I hope all is good in your world. I suppose we ought to go online, shouldn't we? A lot of people pick me up on that because I always forget to hit the online button. Jolly cold here in Cheltenham. It's been raining for like a million years as well, so it's very wet. But we're looking forward to Christmas, which is only 4.5 weeks away. Let's get all excited about that, shall we? Anyway, let's get on to my first topic. And the first topic I want to share with you is a little bit of words of wisdom from a great guy, I think, anyway, love him or hate him. Michael O'Leary from Ryanair is either your hero or your zero, one or the other. But he does actually speak a lot of sense, and I want to talk to you about that right now. And then we're going to jump into SME. So let's go over to some slides, shall we? Let's head over to some visuals. So let's bang that button, head over to some slides, and get on to our first topic, which is recession-proofing your business. Now, we all know about the recession that's come up. Let's just pop in and say hi, shall we? We all know about the recession that's on its way. You can't hide it anymore. There's no point being positive, bouncy little rabbits on this one. The fact is that there's going to be a downturn, and you need to proof yourself for this, particularly if you're self-employed and running your own business. Now, the guy I want to talk to you about is this fella here, Michael O'Leary. So he's looking quite old now, a bit like me, really. Now, he heads up the firm called Ryanair, as you can see. And Ryanair have done particularly well in the pandemic. I don't know if you know much about what they've been up to. And obviously, it's an airline, and airlines have actually struggled during the pandemic. And then as soon as we came out of the pandemic, everybody tried to fly all at once, and it just caused all sorts of issues with staffing, etc. But he's actually done particularly well. Google it, find out a bit more about how they've done well and why they've done well. And he's made a couple of really important decisions that helped him to survive the pandemic and come out gaining market share. And let's just talk about the first thing that he talks about. First of all, he says people don't fly during a recession. They become more price conscious. And it's true. Okay, some people won't fly, and I get that. We don't fly abroad on business anymore, for example. We do online stuff. But Ryanair weren't really a business airline, were they? They were a short haul across to Europe. People will still want their sunshine. They'll want to do it more cost effectively, though, moving forward. And that relates to many products and services. People will have money in their pockets during a recession, just not as much with the cost of living crisis and all those things. So be aware of that. I've got a few ideas to help you with your business with that concept. But the second one I love is this one here. Take market share in an economic nosedive. Do you like the plane analogy there that he's used? I hope that doesn't come true. But take market share. That's the whole point. Because during the pandemic, he did a number of decisions which helped him to come out and gain market share. And maybe that's something that you might want to consider for your mortgage or financial services business. Let me give you a few ideas. Just throw some ideas at you. First of all, you've got to keep prospecting. Keep prospecting for new customers, new clients. Don't stop doing that. They will still be there, but they have different views now. First of all, they will be much more cautious now, and they're going to postpone any major refinancing decisions. So you'll prospect for them and probably keep them warm for a year or so before they make any decisions. That's okay. You're gaining market share here. Secondly, increase your prospecting for this type of business. When you prospect, don't look for immediate decisions. They ain't going to do it. Just prospect to get somebody into your client bank. It's about market share, remember, over here. Maintain the relationship without immediate decisions being required. That's important, that one as well. Build your client bank market share and profit when the upturn occurs, because it will occur. O'Leary did this with his airline. He kept things moving along. He kept promoting and advertising and knew that when people started to get some money in their pockets again and could fly, they would do. And his market share therefore increased. So keep prospecting. Don't stop doing that. Offer courtesy MOTs. We've talked about this before. A courtesy MOT is kind of like a car MOT, but it's for mortgages. It's a complimentary fact find to keep you posted on your long-term goals. That's all it is. It's no wanting them to make any decisions, to buy anything, to take any advice. It's a complimentary fact find to keep posted on their long-term goals. It's a courtesy MOT on their financial situation. That's all it is. It's designed to get clients. You could rebroke existing products if you want to. Maybe get something cheaper during the downturn. Home insurance might be cheaper. Life policies, careful with that, of course. Fixed rates on lending, of course, you could certainly rebroke those. But they won't be costing them any new money, except the mortgage, of course. You might be able to save them a bob or two. Answer on a postcard if you don't know what a bob is. And it's not a haircut, by the way. Anyway, courtesy MOTs for you. Preserve your teams. If you run a business and you've got people working with you in your business, then like O'Leary, don't start laying people off. It's not a nice thing to do anyway. In a recession, it's a horrible thing, however you dress it up. O'Leary didn't lay off any pilots or ground staff. He kept them all on. With furlough, of course, he used all of that. But once, of course, business picked up, they were ready to go, fully motivated and fully trained. Really good decision to make that one. So first of all, preserve your teams as O'Leary did in the pandemic. Team up with others in the same industry and form some partnerships. You don't have to recruit people to expand your team. Team up, get some collaborations going as well. Really useful one. Informal collectors of expertise rather than large bloated companies. There's always a good advice for you to think about. Preserve teams. Cut costs. Yeah, you do need to cut costs because we're probably a bit bloated, aren't we, really? Remove travel costs from your business model. Stop driving around in your big cars to people's houses. Well, I can't tell you what to do, but think about that. Think about the video model as well, of course. Do you need that expensive office and furniture? Possibly not. Maybe the time now is for you to redesign your business model as well. How else could you evolve your business model to be more cost conscious and environmentally conscious as well, and more inclusive? It ticks all the boxes we know about the online video based model, or phone if you want to go that route as well. Maybe the metaverse at some point in the future. Apple, by the way, are bringing in their new metaverse glasses next year. You wait to see what they release. Rather nice. People will buy those straight away. So think about the costs that you carry. Are you bloated, as they say? Products and services cull. Think about your products and services. Strip down your products and services so sell them at lower cost if you can. I don't know what your cost factor is, fees or whatever, but strip it down. See if you can. We're doing that to a lot of our products now. We're stripping them down and reducing the prices or keeping them pegged as they are, because people will have money in their pockets, but not as much as before. This is what always happens in recessions. Retrain yourself. We've talked about this before, and we retrain. Improve your capability now. Don't wait till things pick up. So as soon as your market share has grown and the economy picks up again, because it will, by the way, because it always does. Might take a year or so, but it will certainly come back in again. So improve your capability now. Retrain, enhance your skills and knowledge. Diversify your operation to other areas. We've talked about this before. Many mortgage advisors are pivoting to becoming a financial advisor. So there's some recession strategies for you as well. Last point for you. He did say take market share in an economic nosedive. Now, Shelley and I are flying early in the year. We're going to get somewhere nice, hopefully, at a good price, might ask, with Ryanair. But I hope he doesn't get to it. Don't have the old proper nosedive, otherwise we're goners, aren't we? And we don't want any of that. So that just makes you think about some of his quotations. There you go. So a few ideas for you. We've talked about before, but you do need to think about this. You do need to think about how you're going to change your business model, get yourself through the system as well, which is key. The financial advisor moving may well be one for you to think about, rebroking and all sorts of insurances and other ways of operating. Certainly things you can think of doing. Anyway, Let's get on to the subject of SMI, updated and revisited. Support for mortgage interest. I'm going to go to the whiteboard for this one. So let's just remove this green screen, which of course allows me to show the slides, which is quite smart, isn't it? But I want to go to a good old-fashioned whiteboard now. Hello, over on the whiteboard, where we can talk to you in a good old-fashioned way. Now, the budget last week, or the autumn statement, or whatever they want to call it, introduced a number of changes. One of them was to SMI. Now, SMI, or Support for Mortgage Interest, has been around, and not a lot of people know this, since the early 1990s in one form or another. I remember using the information when I was selling insurances to my clients. I was selling permanent health insurance, or income protection as they now call it. And we talked about people protecting themselves through illness or unemployment, of course, with PPI. Do you remember PPI? And we talked about this 9-month wait. So since the 1990s, income protection has been available to private clients, but SMI is there to help people. And it stands for support for mortgage interest. And it's a government benefit to help people pay their mortgage if they can't afford to pay it. That's the whole point behind it. Now, you may not be able to pay your mortgage because of illness or unemployment, and that's the whole point. Now, the whole issue, though, that's back in the day, and we'll do a little timeline here, I think. There we go. There's my timeline for you to have a look at. Back in the day, you had to be qualifying to have SMI, so you had to be claiming universal credit. So universal credit, of course, is relatively new, really. So you must be claiming universal credit, which is the means-tested one that doesn't need an NI record, or the new style employment and support allowance, or job seekers allowance. Lovely few acronyms going on there. These are known as the new style ones because they are ones which you need an NI record for, and you get a lot more for it. If you don't have an NI record, you get universal credit now. It's all like covered many of the old welfare benefits. So you need to be claiming. So what used to happen, though, is you had to wait for a whole 9 months, 9 months, before anything was paid to you. That was always the rule. It was brought back down again during the financial crash in 2008. Gordon Brown actually reduced it. But our Jeremy, he's actually quietly reduced it again, back down to 3 months. How cool is that? So no longer do you have to wait for 9 months. Let's put that in here. From next spring, so a little bit of a wait, I suppose, you only have to wait for 3 months. Let's put that in there, shall we? 3 months. Before a payment is made to your mortgage lender. So let's just pick up on a couple of facts, figures about this, just to catch you on all the different features as well. First of all, you have a mortgage. Let's just get a different colour pen here. You have a mortgage, and the whole point is you can't afford your mortgage. Let's put that in there. You can't afford your mortgage payments, so you're claiming for the government. First of all, they'll only pay interest on your mortgage, and it's only mortgages up to £200,000 that they cover. Well, whether they'll change that, I don't know, but so that's been around for quite a while. Now, if you are on pensions credit, put a different colour here, it's quite an important one. If you're on pensions credit, there you go. If you're on pensions credit, let's sneak that in there for you so you can see that. Can you see that on the hood? If you're claiming pensions credit, the pensions credit is somebody who's on state pension, and they're completely broke. They're not getting much money at all coming in each week. And it boosts your income up to a certain level for a single person or a couple. It's called pensions credit. It opens up the gates for all sorts of benefits. Even the BBC licence is paid for you as well. But it's for pensioners who don't have a lot of money. That's the whole point. If you're claiming pensions credit, by the way, only people over the age of 65, 66 will claim that. So you might think, well, why have they got a mortgage? Well, think equity release. Then they only actually, they can have a mortgage of 100,000, which is not so generous, really, is it? But they probably hope they haven't got a big mortgage, have they? But they don't have to wait at all. They have an immediate payment, which is a really cool thing for them to do. There's no wait at all, so they don't have this 3-month issue to worry about. Have to think about that for equity. To come back to that in a second or two. So back to the mortgage then. So it pays on a mortgage of less than 200,000. It pays interest only. You've got to be claiming universal credit or employment support allowance or job seekers allowance to get it as well. Now the money that they pay you now, goes straight to the lender. So payment goes straight to the lender. It always has been. And they base the monthly payment on a standard rate of interest. It's currently 2.09%. So no matter what your rate of interest is on your mortgage, they'll cover your interest payments, but only at 2.9%, 09%. That's a standard rate. So they pay that straight to the lender. So you ain't going to get your hands on it and start blowing it. No, it goes straight to the lender. But what it now does is it creates a second charge on your property. So let's just put our house up here because I like my little property. Now the whole point is you've got your first charge, haven't you? Your first mortgage. You get your first charge. And that's the mortgage that you can't pay. It's only up to 200,000. So you're struggling to pay that. So the government are going to start paying interest for you after 3 months. So you ain't going to get repossessed, which is absolutely the rightest thing you could ever think about doing. People losing their homes for repossessions. I remember dealing with that in the building society game years ago. It's horrible, absolutely horrible. So people will stay in their homes, and the kids won't know any difference. They'll all go to school. Everyone will be fine. But this extra loan now, these monthly payments that they're making to you or making to the lender for the second charge. There you go. It's a second charge. There you go. Now, it does actually accrue. There's interest payable on the second charge. Not a lot, 1.4% at the moment. There you go. 1.4%. It's variable, so the rates might change. Now, that's not too high, actually, in the current environment, is it? If you think about it. Just a thought, isn't it? Think about. So that's the second charge. It's repaid when you sell the house, obviously, because you sell the house, you pay the first mortgage, you pay off any second mortgage back to the government. It's not an equity loan, so it doesn't accumulate with the value of the property. It's an amount of money, obviously it accrues each month, more money is paid, but it then has interest attached to it as well, paid on sale. So that's quite important, isn't it? Now, the money it pays you, just give you a couple of. So the payment that goes out to you, it goes to the lender, is interest only. So there's no insurance covered. So if you've got life insurance, you've got buildings and contents insurance, that's not covered at all. And it doesn't cover capital. So there's no capital payments. So you'll have to get your lender to postpone payment of capital. But most people have capital interest mortgages, and lenders are usually quite happy to postpone payments of capital. It means that your mortgage doesn't go up, but then again, it won't go down either. But it's only hopefully a temporary thing. So think about that. So my thoughts, if you're advising life insurance and critical illnesses and things like that, they ain't going to be covered by it. So people might cancel them. What you want to be doing is you want to get them to add WOP, waiver of premium, to the insurance policies, which is for a couple of pounds per month. The insurance company pick up the premiums for you if you're ill and can't pay your premiums. Usually out of work or illness, usually illness, they'll pay the premiums for you. So think about that. You must definitely recommend that as well. So that's SMI. I think it's all right now. The 3-month wait is it's 3 months. It's 3 months, isn't it? It's not 9 months anymore. That's from next spring as well. So that's not too long to wait. So as soon as you go into arrears, tell the lender, you apply for SMI. You've got to be applying for Universal Credit or ESA or JSA. But most people who are ill or unemployed will go for the new style ones, because you'd be a fool if you didn't. And if you don't qualify for those, you'll get Universal Credit. Then you can apply for SMI, comes in 3 months later, gets paid as a second charge. It's a loan on you have to pay it back, but it's not a huge amount of interest rate at the moment. Interesting one, actually, I noticed. I don't know if you noticed this as well, but this pensions credit thing, I don't know why they have the exception for people on pensions credit. It seems a bit odd that, but most people over 65 don't have mortgages. But equity release is available for people over that sort of age. And you have this thing called the RIO, Retirement Interest Only Mortgage, which requires interest payments. So people have to pay interest payments on RIOs. Now, if those people come a cropper and can't make the payments of interest, yes, they could switch the product to a roll-up. Of course they can. But they're rolling up at 6-7% now, and 8% onwards, aren't they? Government only going to roll theirs up at 1.4. Have a think about that. It's just a thought to sort of put in your minds about what we talk about with clients, particularly in the equity release market as well. It's a nice little safety net for somebody that wants to pay interest only on their roll-up mortgage and not have the mortgage expand so much, because at 8-9% roll-up, it won't take long before that mortgage doubles. So that's an update for you on SMI. I hope that has been useful for you as well. I think Jeremy should have made a bit more of a song and dance about that one. No one's given him any applause for that, really, have they? They've moaned about taxes and all those things, but I think he's done a good job there. So that's a good update for you. Bye. Alrighty, so nice little update for you on a couple of items there for you on our weekly live stream on Tuesday this week. Next week, hopefully, we'll be back Monday. Hope you can have a great week. Enjoy yourselves. Have some fun. Enjoy the football. Had a good start, didn't we, against Iran? Was it 6-2? I think it was. Quite a good start, that. So let's hope that keeps going. You just never know. It might be... was it 60 years of hurt now? I don't know, one or the other as well. At least it's only 3 months now on SMI. Maybe the footballers will win the cup. We never know. The World Cup would be nice, wouldn't it? That'd give us a bit of a boost as a nation. Anyway, enough of that. Have a fantastic week, everybody, and I'll see you very soon. Bye for now.